Hello friends, welcome back to part 8 in my Tesla earnings forecast video review series. I am joined, as always, by my co-host Loki, who is up and alert and licking his chops. He is ready to get started. On this video, I'm going to share my desktop with you and show you the thread, the 69 tweet thread, 69 post thread. It always feels better to say tweet than post when in the context of a 69 tweet thread. That I just posted yesterday. So I recorded the first 7 videos a weekend ago, and now I'm recording part 8. So I got all of the pretty charts covered in the first 7 videos. The last 2 of these charts are about Tesla versus Ford versus GM profit per vehicle, which is a little bit of a side tangent from my forecast because they're all actuals. There's no forecast data in there. Not all of these charts have a forecast on them. Some of them are just actuals. Like the free cash flow chart is just actuals because I don't forecast the balance sheet or the statement of cash flows, so I wouldn't be able to tell you what the forecast is for this, so I just gave you actuals on it. But I'm always a little perturbed that when I post my forecast, the most questions I get are about Stevenson indicator, which is the stupidest chart in the whole thing. Like, it's just a dumb line. It's a technical analysis line. That's all it is. It's not doing anything fancy, special, or predictive. It's just being a line on a stock chart, doing what lines do, which is go on and on forever in a straight line. So if you get to this thread after post number 31, you're going to have to hit the show replies button to be able to see more than 31 of the tweets in this thread. I just wanted to let you know that in case you're trying to follow along with me. That was the purpose of scrolling through, doing all the scrolling that I just did, was to let you know that on X, that's how you have to get to these. I'm just going to walk you through them. Here's those Ford versus GM versus Tesla profit per employee charts I mentioned earlier. I'm just going to show you each of these tweets in context in the thread as you will find them when you get to tweet number 35 in the thread and talk about them some. So this is the top of my income statement. I skipped straight to row number 1167 in my detailed model because this is where you get to see it as Tesla will report it in the earnings letter, with revenue broken down by division. And a fairly recent change to this is that we get to see regulatory credits on their own line. Those used to be combined in with automotive sales under the justification that you can't make regulatory credits revenue unless you sell automobiles. But I think the SEC must have said they wanted to see it separately on the income statement. It had always been available in the 10Q, and I think they noted it in the investor letter. But now it's broken out on its own line, as well as leasing and resale revenue on its own line. That's helpful for analysis like the chart that we saw earlier in this thread and earlier in my forecast review video series. But these are actuals from Q1 and Q2, and these are my forecast for the next 6 quarters. The second half of 2024 and the full year 2025, I see revenue growth on the horizon as Tesla sells more vehicles, and in the case of energy generation and storage, as Tesla sells more megapacks. The largest upswing here has already happened in the actuals from 1.6 billion to 3 billion in Q2. That's a lot of megapacks, and I've got kind of conservative-ish looking growth from there, only growing by 1 more billion over the next year. It already grew 1.4 billion sequentially, right? So if it doesn't pare back any, which is always a possibility, maybe Q3 will be less than Q2 was. I don't know. Sometimes that happens. But you can see I've got services and other growing some here. I've got energy generation and storage growing as shown. The way that I build up to this is just guessing at how many megapacks will be sold and then applying revenue per megapack sold in each quarter. kind of the way that I build up to these automotive sales, you'll see later in this forecast review video series the very detailed assumptions that I make about inventory, beginning inventory, ending inventory, production, and deliveries. And then deliveries by type, leased versus regular cash sales. And then I have a forecast for regulatory credits as well. We saw a big quarter in Q2. I don't think these numbers are sustainable. I don't have it growing from there to higher amounts. Maybe it will be. Q1 is typically a strong quarter, so I'm forecasting Q1 to be another big one. But I have smaller numbers after that. This one looks too small. Probably we'll see more than 164 million of regulatory credits in Q3 of 2025. It looks real low on the chart that I showed in one of the previous videos, so I made a mental note to go address that and make it look more like this quarter probably, and this quarter do. Something more like 500,000-ish worth of regulatory credits revenue, so I don't miss by a lot. And then these are just the numbers that you believe if you believe the assumptions that I made at a very detailed level about production by model, by site, and ending inventory. Then you believe the deliveries and the assumptions that I made about revenue per option for every different kind of option you can buy. What's the take rate going to be on that option, and how much will Tesla be able to make in revenue for that item? Offset by the various other impacts to revenue that I have modeled out, including stuff like Tesla now does 0% interest rate financing or 1.9% interest rate financing or whatever it is. That has an unfavorable impact, as you might guess, at the time of sale, because Tesla will want to sell off that financing to a bank, and a bank will want to be paid for taking on repayment terms at only 1.9%. That's a lot less than they're charging people these days. Auto loans might be, I don't know, 6 or 7% or worse. Let me know in the comments below if you know how much auto loans are going for these days. A lot worse than 1.9%. Anyway, so Tesla has to pay those banks a premium to take that that receivable asset off of Tesla's books, so that it reduces Tesla's liability in the event of default on those loans. All right, so that's the revenue section. It's doing what it does based on all the math above. And then we got the cost of sales section right below it. Hey, how much does it cost Tesla to sell automobiles and to lease them? Why isn't there a row for regulatory credits? There's a negligible amount of cost associated with selling regulatory credits. That's not a tangible product, right? It's just taking money from competitors who did not produce enough electric vehicles to comply with applicable law. They're buying your regulatory credits so that they won't have to pay governments more than that much in fines for not having produced enough electric vehicles. Energy generation and storage did see a very healthy margin in Q2, a lot better looking than it was in Q1, and Q1 was pretty profitable. So the energy division is Tesla's most profitable division at this point, just eyeballing this, and there's no reason to expect that to change. The business is what it is, or the products are what they are. So if Tesla keeps selling them at those prices or better, and their costs don't get out of line, we should expect those margins, or maybe a little better margins, to continue as unperformed revenue obligations come due. So there's a long timeline when you deliver megapacks to utilities for them to be able to get those permitted and hooked up to the grid and tested and certified and up and running. And Tesla hasn't earned the revenue until the megapacks are up and running and working properly. So there can be a time delay between when Tesla ships a megapack and when Tesla can declare the revenue from it. So that's kind of the long lead time aspect to revenue being declared on Tesla's income statement as Tesla energy generation and storage revenue versus when those items were produced and when the suppliers needed to be paid for those parts. So it's not great for working capital, but it is a good business over a longer period of time to be in. All right, so here's gross margin, about $4 billion worth of gross margin in Q1 and Q2, which is not bad. I'm forecasting similar amounts in Q3 and Q4. Why is this number a little lower than this number? It's mostly the regulatory credits, right? This flows through as profit, and I'm just not going to make an aggressive forecast that says we're going to get as much as we got last quarter. Or anything very close to that, because I think this was an outlier when Tesla sold a lot of regulatory credits, not just credits they earned during Q2 or Q1 or whatever the normal time lag is between producing and selling vehicles and then selling the regulatory credits. It looks like this was a lumpy quarter where Tesla sold more regulatory credits than they usually or typically will going forward. What's this currency translation impact? There is an impact to doing business globally. If you take international business courses to get your undergraduate business degree or your MBA, as I did, you get to learn all about the fun of doing business under many currencies globally. If you have to convert currencies, then those exchange rates fluctuate over time, and it may or may not be a boneheaded move for you in retrospect to have converted a bunch of your money from dollars to yuan or euros to dollars or whatever business decision you made. If the exchange rate becomes more favorable later, right, you'll take a hit for it. Or maybe it'll turn out to be an accidental genius move and you'll make money because the currency exchange rates will change in your favor. That's one kind of foreign currency impact. The other kind is just a translation impact. So there's a foreign currency exchange impact, which is literally the impact of swapping out one kind of currency for another. This translation impact is a different kind of currency impact, which is just saying, hey, when you report your global earnings, you have to pick one currency to show them in. And whatever that currency is, you need to translate those dollars from whatever bank balances they're in the case of your assets on your balance sheet, or whatever currency you earned revenue in the case of revenue, or whatever expenses you paid in a foreign currency in the case of expense, right? And there can be an impact to just doing that conversion, right? And that's what this translation impact is. It's not saying that you actually swapped out all of your yuan for dollars. Tesla always has yuan in bank accounts in China, right? They need them to clear payroll every week for the folks who work for Tesla in China. This is just the translation impact. You can read up on this on Investopedia, so go check that out if it interests you. Also on this page, we see research and development, SG&A, restructuring and other. So the restructuring and other line is usually zero. I'm forecasting zero for future quarters, but you never know when Tesla might do more layoffs and incur costs associated with that. These are severance expenses. So when you let people go, there are terms of their separation that sometimes involve paying them 12 weeks of salary or whatever. And you wouldn't want to show that up here in automotive cost of sales or, research and development or SG&A, because that wasn't productive work that you were paying them for doing. It needs to hit a restructuring and other line according to the GAAP accounting rules. So that's why you see them separately here. And yeah, I've just got these expenses growing some over time, but growing at a slower rate than Tesla's revenue will grow by. As you can see up here on the Tesla revenue line, you've also got a gross margin percentage row here showing you that gross margins ought to be getting better over time. As Tesla sells more Cybertrucks, they can get away from doing as much promotional discounting as they've been doing lately. This 18% was assisted by all these regulatory credits. If you throw those out, this number was actually 14%. So this 16.5 looks better, or it looks worse than it is. It's actually not that bad. And that gets you to this income or loss from operations line. I guess I'll show you one more tweet in this video, and then I'll call it quits. This slide shows GAAP net income and EPS, not to be confused with non-GAAP, which is the one Wall Street cares about. GAAP is the one that GAAP accountants care about. The FASB, Financial Accounting Standards Board, likes the GAAP net income number. Wall Street doesn't. They like non-GAAP because they don't consider stock-based compensation to be a real expense. It's non-cash. So Wall Street says throw that out and then tell me how much you earned. Trailing 6-month average stock price, a few alternative methodologies for stock price forecasts, not trading advice, and some rows I use to forecast stock compensation expense and other metrics that may be of interest. Okay, so this is just the bottom of the income statement here after the income/loss from operations line. Throughout this section, I tried to orient you to where you are by showing you at the top the same row you saw at the bottom of the previous slide. But you can also just check the row numbers over here and figure out where you are to orient yourself. So here's the earnings. I've got Tesla's best earnings of the year happening in Q4. And I've got Tesla doing better in Q3 than they did in Q2 because the restructuring expense won't happen again, right? That's already hit. That $0.6 billion should not happen again in Q3 or Q4. It's not impossible that something will hit that line, but if it's zero, Tesla ought to do better at the bottom line, even though they're not forecast to make as much in regulatory credits. We should also be done with weirdness happening on the tax line, the provision or benefit for income taxes. These numbers are looking more normal than they did last year. There was a giant $5.93 billion credit. It was a one-time tax benefit from prior year's losses in Q4 of 2023. Just off the page break from what I'm showing you here in column AA, you'd be able to see that large negative number on this row, provision or benefit for income tax. Also, lines that have improved are here, interest income and interest expense. These are looking better than they did in prior years. Tesla doesn't have to pay as much in interest expense these days as they did years ago because Tesla isn't borrowing as much as they did years ago. Zach Kirkhorn, when he was CFO, got those expenses, or those loans, almost entirely paid off early. So Tesla's only doing a small amount of financing, which might just be a revolving credit facility or whatever very normal corporate business borrowing they teach you in MBA school you should be doing to manage your treasury effectively. It's also a good way to hedge against foreign currency impacts is to borrow in foreign currency if you know you're going to have to repay that obligation in foreign currency. That way you don't get impacted no matter what happens with the exchange rates between your home currency and that foreign currency. You borrowed in yuan and you pay it back in yuan, and there's no foreign currency exchange impact that way. So it's a good way of hedging against that risk. And Tesla's got, what, $30 billion worth of cash? So that's what this interest income is coming from. You get 1% per quarter worth of interest. That's pretty good. So Tesla must be investing in treasury bills or bonds or notes or something boring that gives them a good rate of return. This is just $300 million more per quarter worth of profit. I mean, without these numbers would look worse, right? So it's good to have a bunch of cash sitting around. Warren Buffett will tell you he's sitting on $250 billion worth of cash right now, something like that, from having sold off mostly his Apple investment lately. All right, so that gets you to these GAAP net income numbers. If you add stock-based compensation to these, you get the non-GAAP. So here's the share count, here's the EPS numbers if you do them on a GAAP basis instead of on a non-GAAP basis. Most people don't do it that way, so this is kind of just here for information purposes. But good to see that we're forecasting twice as much GAAP EPS in Q4 as we actually saw in Q1, which was not that good a quarter. I've got a stock price forecast here that I had to make in order to forecast Elon's bonus. So you can see what I'm forecasting on this row for Tesla stock prices. Not financial advice, do your own research for entertainment purposes only, etc. Here's the trailing 6-month average stock price forecast. And here's the trailing 6-month market capitalization for Tesla. So kind of affordable in this bear market that we've been in since the end of 2022. Here are some of the stock-based compensation metrics. Maybe I have to do one more slide in this video to finish up that thought about Elon's stock-based compensation under his 2018 Performance Award. This is the plan that is currently being litigated in a Delaware court presided over by Chancellor Kathleen St. Jude McCormick and being fought by Alexandra Mertz and Amy SF Tahoe, I think is her handle on X, trying to make sure Tesla doesn't lose this lawsuit, which would be the only compensation Elon Musk could get for a 6-year period of time from 2018 to 2024. He earned no salary, no wages, no overtime, no bonus, nothing other than this plan that I was modeling on these rows. And there have been no shares awarded to him over this period of time. I've got some creeping in my forecast, which I need to adjust because the board can't start compensating him again until shareholders approve it. So I think it'll be Q3 of next year before Elon can start earning more stock-based compensation because they'll have to propose it before the annual shareholders meeting and the vote. So I got a little bit of cleaning up to do here. These are not large numbers. But then in this section, I show you how much CEO stock compensation there is in my forecast. I don't have anything going out until Q3 or Q4 next year. Other SG&A stock compensation continues getting paid. So a lot of folks who work in Tesla corporate jobs rather than at a factory making stuff are getting paid part of their compensation as stock and the rest as regular SG&A expenses, wages, salaries, benefits, payroll taxes, etc. are all here, making total SG&A expense of these three things combined. And then there's more stock compensation that goes out to people who work in factories and to people who work in research and development. And if there were layoffs and they are awarded that way, they would hit here as well. So that gets you to your total stock-based compensation. And Tesla has started reporting how much taxes they pay on stock-based compensation because one of the numbers, I think it might be on the statement of cash flows or the reconciliation of non-GAAP to or GAAP to EBITDA, whatever that page is. They're breaking out their taxes on stock-based compensation separately. So there's two different stock-based compensation numbers now in the earnings letter. There's this one, and then there's this one net of this one. So you can find one stock-based compensation number that's just $432 million instead of $563 million. Well, that's Q4. I should have given you the Q2 number. $334 million instead of $439 million you can find in the earnings letter if you're a big nerd who cares about that sort of thing. And with that, I will end this video. After I check in with Loki, who is curled up in his bed snoozing right now, and remind you to like the video if you liked the video, give it a thumbs up, give it a heart, depending on where you are. And don't forget to sign up, follow me, subscribe, whatever you want to do if you're into that. And a special shout out to my two executive producers, Kathy Kitchler and Rebellionaire.com, and I'll see you in the next one.